Good morning and welcome to Real Estate Economics Weekly Webinar Series. This particular webinar covers San Diego County. This is part 3 of 5, so if you'd like to see all 5 in streaming high def, make sure you collect and view all the pieces. Part 3 of 5 will deal with supply, demand, and demographics. Shown in this graph is housing supply for San Diego County. As you can see, the housing supply tends to grow very slowly over time. This entire series represents less than 1% growth per year. If you think about houses in any given market area, there's many older homes that transition into retail uses, commercial uses, office uses over time, or convert to some other use, or become substandard or burn down, whatever. This rate of growth is barely sufficient, really insufficient, to maintain the same level of housing stock on a per job or per person basis. Everyone who's in this industry recognizes that acquiring land and gaining entitlements and financing and doing product formulation and marketing is time consuming, and you can see this in the growth rates here. It just tends to grow very slowly over time. If we look at this on an annual basis, it tends to run a little bit more in sync with the economy. You can see the early 1990s series when we had defense cutbacks and the San Diego military and naval was strongly affected. Then we had a big run-up in the early 2000s associated in some cases with .com and biotech, some of those things. This area doesn't appear to suffer much during the .com boom. And then we really didn't add that much housing in the early boom years that most of the region experienced. If you look at 2004, 5, and 6, permits are about on par. In part that's due to a lot of the developable land being far from employment, in outlying areas, and so it's a little less efficient to build in mass far from employment, but it gives opportunities to build in high rises and some other higher density concepts that aren't well represented in many other markets regionally. If you look at the 2010 data, just 2,662 permits. That's by far the lowest series, going all the way back to 1991, when the job base was 80% of its current size. So really the housing supply that we're putting out in the last few years and during the forecast period is very, very small for a job base of this size. Here's the building permit data. Single family, as you can see, is shown in blue, multifamily ringed in red, and the total ringed in green. Again, this is mirroring the economic cycles with slow periods in 92, 93, 94, and the peak periods a little earlier than most markets nationally. What we see across the West is a lot of building permit activity, generally in 04, 05, 06, and even in a little bit into 2007. San Diego is typically ahead of that cycle, comes out of the last recession sooner, peaks sooner, rolls over sooner, and we think that trend is holding. If you look out to 2009, we've got several very, very slow years before we start to accelerate in the outer years of the forecast. Here are those numbers numerically. We have to go all the way back to 2001 to see a year where single-family permits were over 10,000, and we don't have another year really that's close in the forecast. Single-family permits, again, are growing very slowly. Land availability is poor. On the multifamily side, though, the multifamily, if you think about it, is in close to downtown, much closer to employment, fits well with retired buyers, fits well with a whole bunch of different profiles, international buyers, and so forth. So there are going to be continued opportunities on the multifamily side despite the condo glut that we're still suffering through. As you can see, the multifamily side is very low now, but it's going to grow quite rapidly in the forecast period and really represent the lion's share of permits in the years ahead. Here's the supply and demand pattern shown together. We talked just a moment ago about the blue supply line, how slow that grows, oscillating a little tiny bit with the economic conditions. Compare that to the demand for housing shown in the green line. Now that demand oscillates completely, or not completely, but very well correlated to employment. So during periods of weak employment, the demand is way less than the supply. Prices tend to fall. But then the job market is usually much more dynamic, so it can go from weak to strong, as you can see from 96 to about 2001, over a 4 or 5 year period, and supply can't keep up. So the only way for that demand to manifest itself is through rapid price appreciation, which we've experienced in this market. Now if you come out to 2009 and conditions reverse, suddenly the economy goes from strong and relatively healthy to very weak in a short amount of time. The green line drops back below the supply line, and you can see demand is below supply for the next 4 or 5 years. That tends to put pressure on house prices, although it's maybe not quite that simple. There's tends to be very good demand for distressed houses and foreclosed homes. We've got rental investors, flippers, remodelers, all kinds of people going through that REO inventory, paying cash in many cases, and putting those homes into the grossly undersupplied rental stock for a few years until an opportunity presents itself to sell. Here's change in household income. I think really the short approach to this is that over time most households tend to migrate into higher income brackets. Two-earner households are more common. As people age, their peak earning years come along, and just for a variety of factors, they tend to migrate up the food chain, if you will, so that at some point in their life cycle they're in an income bracket that's capable of supporting buying a home. Here's the population change by age group. So you can see where the big growth population brackets are. 55 to 64 is of course the baby boomers, 65 to 74 the older boomers, and 45 to 54 the up and coming group. If you're building a primary housing community in this market, it really suggests that you include an age-targeted or age-friendly floor plan. Include something that appeals to this group, because not only are there a whole bunch of them, but they tend to bring equity, accumulated equity from other homes. They tend to buy premium lots quite often. They spend more on options, more on upgrades, and like to reward themselves for their years in the workforce. By contrast, many of the entry-level buyers are scraping together every cent to meet new, tighter underwriting criteria. So don't forget the mature buyers in this market. You can see it even more clearly here if you go out to the age 55 to 64 group. In the year 2000, we were just barely over 200,000, about 201, 175, and by 2014 we're going to be in the 360,000 range. That's 160,000 additional buyers just in that bracket. Spread that out over 10 years, and that's enough to more than cover all the permits that we just talked about in a previous slide. So that's a great area to target. Look at the 45 to 54. Mobility rates, your willingness to move tends to go down quite rapidly as you age, so the time to really approach and target those mature buyers is the 45 to 54 slot. That's part 3. If you want to watch the whole series for San Diego County, make sure you see 5 out of 5 in streaming high def.